The credit crisis and the economic downturn has really had a big impact on pension schemes. Clearly, with most pension schemes being 50 to 70% invested in equities, whether it's company pension schemes or individuals, the stock market crashes of the last 1 to 2 years has really hit everyone in a very big way. Fortunately, those assets, stock market assets in particular, have risen again since April. So in the UK, we've seen a 20% improvement in share prices in the value of assets. So that's good. But in terms of the value of pensions and the liabilities, that's not so good. Bond yields, which really drive the value of liabilities for company purposes, were very, very high during the economic downturn, but are reducing. And some companies, I think, are taking comfort from that fact. Their liabilities were very, very much lower than they expected. But those liabilities are now growing with bond yields reducing to more normal levels. But probably what's much more important, and what is really the true economic cost of pensions, is how trustees are valuing the liabilities in line with gilts. And with gilt yields being low, pension liabilities are much higher than maybe companies would want. And with inflation, long-term inflation beginning to edge upwards, that's also having a big impact. So we're seeing real big increases in deficits for trustees, which means more cash being required from businesses just at the wrong time, as businesses are beginning to think they're coming out of recession. It's pretty inevitable, I think, now that we will see state pension age being increased at least to age 66, and the conservatives are talking about 67, and higher ages are probably not uncommon in Europe. The funded pension schemes in the public sector are also in not great shape, and we'll see that next year with the local government valuations of pension schemes, which will see much bigger deficits, I'm sure, and also pressure on council tax. What North West companies are really beginning to do now, probably for the first time, is think the unthinkable and think about closing down their pension schemes. So closing the schemes for future benefits for current employees. It's a major step to take, has a big impact and consequences for employer relations and for employees. Unfortunately, that means the ending of good quality defined benefit schemes. Employers are also looking very closely at how they manage the investment risk that these pension schemes bring, because at the moment the trustees make decisions about investment strategy, and if it goes wrong, the employers pick up the bill in higher cash funding requirements. And then an issue that will affect most North West companies is the changes in legislation in 2012, which will require all employees, whoever they work for, apart from the very smallest companies in this region, to participate in a national pension savings scheme. And that will bring additional pensions cost for all businesses. So sectors such as the retail sector are going to be very badly affected by that. So that's a big challenge at the moment. The tax charges in the April budget will have a big impact on high earners across this region. The tax charge means for the very first time that being a member of a pension scheme is going to be taxed, but only for high earners, people earning over £150,000. Essentially what it will do for many individuals in good quality pension schemes will be double the cost of them participating in the scheme. So if they were paying 8% of salary, ultimately they're going to have to pay about 16% of salary. And that will come through in their self-assessment tax return. Unfortunately, the economic downturn and the impact in the stock market in terms of big falls in all stock markets has had a very negative effect on individuals' pension funds. That's led to many people, I think, losing confidence in the stock market and wondering even whether it's worth saving for pensions. It's a comment I've heard quite often. What's important is that individuals remain confident if they are investing for the long term, and that's what they should be doing if they're saving for their retirement. These cycles do come round, and actually remaining invested in equities when you're a long time off retirement, provided you've considered the risks, remains the best thing to do. Importantly, there's a lot of education that is needed around this point that has to come from employers as well as the wider society.